Now, the emerging market rally continues. US dollars depreciation and the resurgence of global growth were some of the top three drivers behind a double-digit rally in global equities last year. Is as per the MSCI, stocks were led by MSCI's emerging market index, 38% return. And as we enter into 2018, will investors have to monitor whether the themes continue to the new year or no, and what kind of allocation should they take between developed markets and emerging markets? That is probably the key question. And I think in a release that they gave out, at least which came to us yesterday, there were some very interesting charts that they put up, and which is what we should essentially be dwelling on, the kind of difference between MSCI EMs and MSCI developed markets. Now that chart is a correlation. The blue line that you see is the correlation of MSCI EM to MSCI World, and why the correlation may have dropped a bit is just showing signs of flattening out and bottoming out. And if the blue bars, which is the world market growth, and the pink bar, which is the MSCI EM market, if those starting moving up and continue to move up in line with global growth, then maybe there is no reason to doubt that this EM rally could well continue, simply because it is not just a factor of EMs, it is also a factor of what the world is doing and the EM growth following the world growth, or vice versa, but essentially both moving in tandem. So that was one very interesting chart that MSCI has put out. They of course talk about how currency has given a big boost to dollar-based investors across the world. It may be different for different countries, but by and large, the overall gains and the currency boost is giving a big boost to dollar-based investors, and therefore all foreign investors should be fairly happy with a large portion of their investments as well. And last but not the least, in one of the other charts, they've given how real earnings growth have driven returns in 2017. Now, you could argue that in India that hasn't happened, but if in 2018 the real earnings growth comes back, and if the IMS forecast is to be believed, with the GDP growth looking very healthy in 2018, it won't happen without the listed entities giving out those returns on the results. Then you probably poised for good growth numbers within India as well. But the fact that they are saying that it's real earnings growth which is driving returns and not just perception is something that is very, very interesting. Last but not the least, this was, I'll just try and make sense of the chart out here. They are talking about how the developed market returns versus emerging market country returns in 2017. And what they are saying is, the one word of caution that I thought they're sounding off is that the risk to reward profile, which arguably should be much better for the developed world as opposed to the emerging market world, because the risks in investing for any foreign investor or any investor in the developed market would perceptibly be lesser. But the risk reward profile of the EMs and the DMs have converged. You look at all the blue dots, and they are the emerging markets, and India, China, South Africa, Korea, all of them top when it comes to the returns. And then on the real earnings growth, of course, a lot of these have gone ahead as well, the likes of Korea, for example. But developed markets are performing on the real earnings growth basis, and yet the profile of risk return is similar right now. To my mind, I think what they're trying to say is that needs to change a bit, but that's probably that only word of caution that I thought was there in this note. Otherwise, they're essentially saying that this emerging market rally is in line with the global market rally, and maybe just there is no need to panic as yet.